Welcome back to the channel. In this video, I'm going to be talking about the UK stocks that I'm buying right now. Some news on a few companies such as Argo Blockchain, Shein, as well as Twitter and Distill PLC, and one you may not already know of. We've also got two comments of the week this week. Then I'm also going to give you a performance update for the 2 years that I've been invested, or since I've started the channel, picking individual stocks and equities. And the results are maybe going to surprise you. So let's jump into it. First things first, I'm on Twitter here because it's the best way I can get this news, because every damn media outlet wants you to pay for a subscription. Effectively here, what's happened is Shein, who is a big fast fashion retailer from China, they are valued at $100 billion based on a private funding of a £1 billion dollar investment. This is due to the fact that they have a revenue of about $15 billion at the moment, I believe, but they're saying that supposedly they could generate $20 billion of revenue in 2022. You may go, well, you're wearing a Boohoo shirt. You're not concerned about Shein. Realistically, not really. Yes, they are a behemoth, and yes, they could be a threat, but so long as they keep their distribution in China, they are at a disadvantage. But don't get me wrong, they very much have the capital available to start distributing elsewhere. And obviously, they ship it all from China, but they really need to set up supply chains and factories in these countries, because at the end of the day, Boohoo is going to have the better designs, but Shein is popular, don't get me wrong, but they're going to get knocked out. Yes, they can win on pricing power, which is very important in fast fashion. However, the beauty of fast fashion is that it arrives quickly. When you want to buy clothing on an impulse moment, you want to buy some clothes and get it the next day. You don't want to wait 3 weeks for it, because at that point, what is the point? So Shein here, a very interesting valuation at a $20 billion. Let's just say they hit $20 billion in revenue, and they're valued at $100 billion. That puts them on a price to sales ratio of about 5 times. Furthermore, if we assume that they've got 10% profit margins, which is high, but I think that's reasonable based on Boohoo's and where China is going to be a lot cheaper to manufacture, we're looking at what, $2 billion in earnings, which would put them at a price to earnings ratio of about 50 times, which I think is a little bit on the pricier side. But then again, Boohoo in its history has also been at a price such as that. We've also had Argo Blockchain's March 2022 operational update. They've mentioned here that they've mined 163 Bitcoin compared to 135 Bitcoin in February 2022. This amounted to a revenue of £5.2 million compared to £4.15 million in February. Their margins are also higher. They were at 74% this month compared to 71% last month, and they now hold 2,700 Bitcoin or Bitcoin equivalents on the balance sheet. And they've also mentioned that the facility is very close to completion. I believe they're saying there's significant progress on this stage of construction. Expects mining operations to commence in Helios in Q2 of 2022. So that Helios facility that everyone's been talking about is finally going to be up and operational. And it will be interesting to see how much more Bitcoin they're going to mine. How much is their efficiency going to go up? Because after all, they're going to be using renewable energy, supposedly the cheapest electricity rates in the world. So hopefully we would expect a very high boost, especially as they are obviously swapping a lot of their fleet for a more efficient pro model of their Bitcoin miner. So effectively here, we may see a rebound back to the high 80% mining margins. However, I'm going to say that this is unlikely. I think this is going to be a disappointment. And yes, I did sell out at a 50% loss, and I have no malice towards any of the shareholders of Argo Blockchain, nor am I bothered if it goes up or down, because at the end of the day, I made my decision to sell because I don't understand it. And therefore, if I don't understand it, maybe you don't want to listen to this. But I'm going to mention it anyway, and you can skip ahead if that bothers you. I feel that what they were doing is that they were turning machines off at inefficient times. So times where electricity was high, they were turning the machines off. And there's a positive and a negative of this. The positive is that you have higher margins, and perhaps it reduces depreciation, but I don't know if that's proven. The negative is that you're mining a lot less Bitcoin, and therefore you're making less money with your machines. It may mean the machines depreciate faster, but I'm sure you can do the calculations and work it out that it's very likely that by running the machines for an extra hour or two a day during peak times, yes, your margins are going to be a bit lower, but at the end of the day, you're going to be generating more revenue so that you can grow faster. And I think compared to the other miners in the industry, they've had consistently quite poor results, and it seems like they've artificially inflated their mining margins, and that made them more attractive than they maybe actually are. One that has been trading at around about 70 pence per share, I sold out about 94 pence at 50% loss. We've also had a trading update from Distill PLC, and if you haven't been a keen watcher of the channel, you likely don't know who Distill PLC is, but they are a very, very small brand. I'm talking a market capitalization of less than £10 million. So watch out if you're interested in investing, because there's going to be a high spread between the bid and the offer price, so keep that in mind. But they've mentioned here, in quarter four, their volumes increased by 38%. Their revenues have increased by 32%. Oh, they have had a much larger investment in brand marketing and development by 156%. However, the main driver of growth is their spiced rum brand, Red Leg Spiced Rum. Now, this is on the premium side of the market, and at the moment, the type of alcohols that are trading are flavoured alcohols. You're seeing all of these flavored rums, you're seeing pineapple rums, and at the moment it very much now is moving into vodka. It used to be quite the hype for gins. It was like, ooh, I want a raspberry and ginger gin, that sounds great. And now it's moved on to rums and also vodka, and I think actually, if anything, it's transitioning further into vodka now. I think at the moment that's very much the current hype, but I think rums do it better, and I think it is going to be something that's more longer lasting rather than a short-term trend here. In this way, Red Leg Spiced Rum is in a good position. At the moment, they're setting up their facility and they're building an Ardgowan distillery to produce their own form of whiskey. They're very much diversifying, and I think this is a company that, should they play the cards right, they should be doing well going forward. And I think with a brand like that, and I would hope that over time they would be able to improve. They have a cash balance of 1.56 million, but they've also loaned money to help the building of this Ardgowan facility, as it's a joint partnership that's taken place. It's a very complicated loan, and that's why I've kind of held off investing. And it's very much the idea that a lot of younger people are drinking a lot more spirits compared to drafts. And don't get me wrong, yes, people drink both, but it does seem like it's weighted heavier to the fact that younger people are more likely to drink drafts. Ale volumes, for instance, they are very popular amongst the older ages in the population, but in the younger ages, it's few and far between. And that's not to say there aren't young people that drink ale, for example, because I do personally. But I do feel that it's very much a trend, and I think in this way it's good to keep an eye on it and perhaps be invested in these types of spirits. We've also got Elon Musk buying a 9.2% stake in Twitter after hinting at a shake-up. And I think someone had mentioned on Twitter to do with the, I wish we could get this free speech. Are you thinking about creating your own social media platform? And Elon Musk responded at the time by going, it's tempting, or something of the like, and not long after we see him buy a stake in Twitter. Now, this, in my opinion, is a very clever move. This is a person that is the highest net worth individual in the world, and an investment of this size is inconsequential to him. Twitter, the business itself, I'm not really a fan of. I use the platform. I think it can be productive if tailored to your needs, but it's very much a lot of rubbish other than that. And the thing is, they don't know how to monetize their platform. They just straight up aren't doing it. They're not good at that compared to Facebook and other brands such as YouTube. Twitter, though, and I don't think this is what Elon Musk is doing. I don't think he's actually going to be here to grow the company, but rather I think he's going to use this stake, this exposure, to very much boost his own following and the people that know of him. Then there's going to be more eyes driven to that, and effectively it's a very cheap way of marketing, especially as the stake is likely going to hold its value over time, dependent obviously on the performance of the company. What do you think of Elon Musk's move on buying Twitter here? If you had his kind of capital, would you make the same move? Or do you think he is making another meme, another joke, and it's not going to go far, and actually it could be the downfall of him? I personally believe it's the former. I think he's going to do quite well with this exposure that he's going to get will be good. And if we see Twitter turn around and actually that he does act as an active investor, then it would be quite interesting to see how it disrupts the social media industry, as I do feel that, in my opinion, it's become very stagnant, full of adverts, and in fact not really worthwhile for your time unless tailored, as mentioned before. So we've got two comments of the week. We've got the one from last week, which I've mentioned before, and I'm not going to read it again. However, the response to this comment, in my opinion, was pretty funny. So, I'm going to say it. Your viewers drop quicker than your shares, take your losses and enjoy the money. I mentioned my response last time. Fair play on the other comment there that's being nice and positive. But, here we are, the very bottom. Take some mushrooms and learn to be a nicer person. That right there is a fantastic comment in my opinion. And we've also got another comment here asking why I didn't hedge my individual stock positions with an index fund, as it's typically something that newer people are recommended to do, as it gives them some diversification and some stability in the portfolio. I'm arrogant. I believe that I can outperform the index funds by investing in individual stocks and equities, and therefore if I want to outperform the markets, I might as well commit fully to it. I know my own mindset here, and I know that if I was only 20% individual stocks and equities, I'm only going to put 20% of my time, effort, and energy into making sure that I've got the top quality stock picks, in my opinion. Therefore, by not holding these index funds, I'm relying on my own stock picking skills in picking quality companies, and the mistakes I make whilst I have a low level of capital are very critical for growth in terms of learning, so that at the moment, if I lose money, I lose money. It is what it is, right? But longer term, once I have got substantially more wealth, at least then I know exactly what will happen in the markets. Well, not in that regard, but I will see the trends that lead up to a mistake, perhaps the fear of missing out, and avoid it, because I would have gone down that path before at a much earlier stage. And don't get me wrong, you can do that with an index fund as well, but as I say, I want to outperform the markets, and I don't like index funds. Typically, yes, I do think they're good in global diversification, but typically, like the ones in the UK, they're so heavily exposed to the UK markets, and I believe that the top of the UK markets, the ones with the highest, the largest sizes, the most cash flow, well, in this regard, it is just market capitalization, the largest market capitalization companies in the UK, I think they're low quality, and that's that. Like these big companies, Shell, I'm talking GSK, AstraZeneca, the banks, all old world companies. It's not to say they're going anywhere anytime soon, but they're not going to grow, and that's not what I'm interested in. I did formerly invest for dividends, but now I'm not interested in that as much. Whilst I would like some dividend income here and there, I'm very much interested in the business being able to grow, and investing in the biggest companies at a high weighting is obviously going to provide diversification and be less risky, but effectively I might as well dive into the deep end, do the research, and make sure the quality of the companies are top notch with high amounts of cash and low amounts of debt, and a future where I think they're going to grow, because I ultimately think that that is less risky. You might go, well, it's more volatile. It can go up and down more. It can, but that doesn't necessarily make it risky unless you are prone to obviously listening to your emotions and panicking. I could see Boohoo drop by 80%, and it has in the last year for the record. It's now about 72% down, but when we're talking back when it dropped to 60%, it was hitting 80% down in 1 year. I went all the way through that. I still hold Boohoo, and I'm not bothered. This is because it's money that I don't immediately need. It's money that can go away for the future, and in fact, I could lose 90% of my capital because I know that I've got a career ahead of me where I can build money and rebuild it back up. The lessons learned from the capital that could be lost at the moment are so much greater than the amount that can be made, in my opinion. Then, this brings us on to the portfolio. So, we can see here that I currently hold 13,330 shares of Boohoo Group at an average price of £1.61. Obviously, it's slightly more to the middle. I'm not going to round, well, I have rounded it. And here, I'm quite comfortable with this position size. I'm buying a lot slower at the moment. You can see my cash position is only 4% of the portfolio. And at the moment, I'm very much pacing it. I've set some limit buys on Boohoo, I think, for about 85 pence per share and 82 pence per share, which I set actually 2 weeks ago. But shares obviously hit a bit of a euphoria. They climbed up quite high this week, and therefore, obviously, I've kind of just let it chill, let it do its own thing, and then leave it at that. But I am interested, and I will be buying more. As I've said before, I want to build my stake up to about 20,000 shares where possible. The next goal was obviously 15,000 shares, and it was well put by a comment in the comment section, is that once you get to 20,000 shares, for every penny that Boohoo goes up, you make £200. That is no small sum whatsoever. And if Boohoo does, for instance, return to £4 a share, that's a lot of money right there when you do the maths, or at least in my position, I would find that to be a lot of money at the moment. I also do still hold Games Workshop, where I hold 77 shares of that, making up 31.4% of the portfolio. I think there is a dividend on the way at some point soon, but it's something that I'm not too bothered about at the moment. I'm letting it sit there. It's not down enough to be of enough value to me. I bought at quite a premium, I suppose, but I'm very much interested in Boohoo. It's down 44%. I can average down, really lower my average price, which I want to get to about £1.25. That'd really be an ideal level there, and obviously I'm going to change this each time, but 125 is where I really want to get greedy and let it go to. Boohoo, I think, is going to be stagnant. Well, I hope it's stagnant for the next 12 months, giving me ample time to really reach this average and build the position up. I'm actually going to add a graph to my portfolio, or the spreadsheet that you can see on the screen here, where I'm actually going to set 2 portfolio diversifications. The one you've got now, which is based on live holdings and current prices size, But I also want to look at one that is dependent on the invested value, so the original value of the investments. Because if you look at the column underneath Friday there, you can see that actually the original values, I have bought 3 times more in Boohoo than I have obviously in Games Workshop, which is no small figure whatsoever. I'm also looking to diversify at some point and buy another company. However, I'm not rushing into that at the moment. I'm very happy to keep acquiring Boohoo shares. So in 2 years, I have, 732 days, because obviously we're talking about working days, but I started investing in the new tax year of 2020. I have gotten very, very strong returns of 40% or 40.68%, but it's negative. So I've actually lost 40.68% of my portfolio. I'm not concerned about this, as for reasons I spoke before. I'm a long-term investor. Therefore, 2 years in, this is not something that bothers me. And you might go, well, it's 2 years. That's long enough. Why aren't you making money? It's been a bull market. You're awful. Get off of YouTube. Go home. I have actually no words. It doesn't bother me. I'm playing the long game, as I said before. Oh well, I'm going to keep doing it. I'm going to keep grinding. I'm going to do my thing. So if you don't like that, then bog off, really. But realistically here, Boohoo has been priced down massively. I did overexpose myself to this position at a higher price. Same with Games Workshop. It's been a critical learning lesson to use valuations more keenly and make sure that you don't become too detached from price to earnings, price to book, and be aware of what you think the underlying value of the business is. Whereas now I feel that Boohoo obviously has its own value, whereas before I was just buying it with hopes that it would increase in value based on their financial growth. And again, we've seen that their financial growth has slowed down, and therefore the valuation has been squeezed considerably. If you're interested in what a dividend is, then click the card at the top right of the video. I break down so many things about dividends, dividend histories, yields, payments, all of the like. And if you'd like the video, please one of these, as it is much appreciated. Have a fantastic day.